40% correction in one stock, 20% in the other. The stocks of Mamaearth, which is Honasa Consumer, and MapMyIndia, CE Infosystem, served a crude reminder to investors in the last 3 months of 2024. For a while now, investors in Indian stock markets did not mind paying even triple-digit earnings multiple for new age businesses or recently listed stocks. But a sharp correction in valuations on the back of negative updates showed the vulnerability of the earnings multiples. Now, there are usual cases of several stocks that get dumped due to poor quarterly earnings. After the September quarter results of 2024, we witnessed several stocks facing investor apathy for not meeting lofty high earnings expectations. But the case for Honasa and CE Infosystems were different. Investors got a peek into the failing corporate governance in the relatively newly listed stocks when the management transparency was found lacking. Honasa Consumer, the parent company of Mamaearth, sells beauty and personal care products which are branded under the Mamaearth, Dr. Sheth's, Aqualogica and BBlunt brands. Distributors of Honasa had raised concerns over excessive inventory dumping. It seems the personal care company had dispatched excessive inventory to the market. Plus, there were delays in replacing damaged, unsold and expired stocks. According to the All India Consumer Products Distribution Federation, goods worth up to 1 billion were stuck with distributors. The inventory pile-up happened as Honasa, which started out as an online venture, attempted at building a wider offline presence. The Federation claimed that distributors were saddled with 90 days worth of stocks from Honasa. Against this, most FMCG companies stock for about 20 to 30 days. Distributors then replenished the stock with retail outlets. Honasa refuted the association's claims that there was a high risk of stock expiry at warehouses and retail outlets. Moreover, substantial volumes of unsold inventory were being returned by retailers. Turns out this was a case of change in distribution strategy gone awry. Honasa wanted to move to a direct distribution model in the top 50 cities. This was after phasing out its previous reliance on super stockists. This transition, though implemented in the third quarter of financial year 2024, had not been smooth over several months. A communication with regard to the same to investors could have saved the stock from the sharp slide in the last half of 2024 after the negative news. Similarly, CE Infosystems, which is MapMyIndia and provides data to Apple Maps, Amazon Alexa, recently informed stock exchanges that its Chief Executive Officer, Rohan Verma, would step down and start a new business-to-consumer venture. The company will transfer its Maple Mall and travel app for hotel and flight booking to the new company. The ex-CEO Rohan Verma would now own 90% of the new venture, while MapMyIndia will spend 1 million rupees to acquire 10% equity and invest 350 million through compulsorily convertible debentures. On the face of it, the transaction seems completely against the interest of minority shareholders of MapMyIndia in the near term. The best alternative would have been to set up a 100% subsidiary to create value for existing shareholders and have the CEO compensated for managing both. So, the sudden decision to transfer the CEO of the company to a new entity and also use the company's funds to start a private venture did not go well with minority shareholders of MapMyIndia, and the stock bore the brunt. Now, both the cases of Mamaearth and MapMyIndia were not instances of fraud or outright breach of law. This is unlike the cases of Manpasan Beverages, where SEBI had barred the entity from the securities market for a period of 3 years for manipulating and misreporting the company's financial statements. The Vadodara-based company had been at the center of controversy since Deloitte resigned as its auditor in May 2018. Things went downhill after its top brass was arrested for the goods and service tax fraud of Rs 400 million in 2019. Therefore, unlike 1% beverages, the stocks of Mamaearth and MapMyIndia are unlikely to face a permanent damage to reputation or loss of valuations. However, the latter could have certainly avoided losing investor trust with more transparent communication. This also raises the question of role of independent directors in such cases of corporate governance failure. Back in 2009, when the chairman of Satyam Computers was suspected of falsifying the company's books of accounts over several years, the independent director's responsibility came into question for not identifying the misrepresentation made in the company's books. Similar concerns emerged during the Tata Group boardroom dispute that was between late Mr. Ratan Tata and late Mr. Cyrus Mistry. A few years back, Infosys revered for its corporate governance standards faced regulatory scrutiny, with SEBI highlighting issues like ineffective audit committees and lack of independence amongst directors. Further, the role of auditors in reporting the cases that seem a breach of corporate governance are few and far between. However, like I pointed out in my video earlier, auditor resignations in small cap entities have been an important reason to be skeptical about the quality of management. So, are there more Mamaearth and MapMyIndia like shocks in the offing? Well, when stocks are priced to perfection, any wrongdoing on the part of the management, whether deliberate or not, is bound to be punished. So, even though there may be not cases of outright frauds, companies that fail to live up to the desired standards of corporate governance can get re-rated lower. It is therefore up to investors to ensure that they do not overpay for stocks that do not have a long history of quality governance standard. Also, managements that fail to keep the interest of minority shareholders in mind deserve to be passed. Hope you like this video. Thanks for watching.